Hey everybody, it's Michael Martin. Thanks for being here. Thank you also for all the comments on the last video about, not looking at your P&L. It's so hard, right? It's so hard to not do that. When I was starting out, of course, I was a little caught up in the action, right? So it was hard. The good news is that the stocks were trading in eighths. So and there were a lot of market makers, there were specialists on the floor. Now everything is electronic, so and decimalization, so it's kind of a free for all. You can start to see it as like a bit of a video game, and being able to emotionally detach from what you're seeing there in real time and just to focus on your process, to me, is the single best thing that you can do. There are four other things, though, that I needed to figure out along the way. Again, I grew up in a different environment than the one that you're in right now, but I still think that these are principles that have withstood the test of time. Withstood, it's a funny word. All right, so in no particular order, I have these written down. Piece of paper right here. The first thing, and I've mentioned it before, that had a material impact was that I have always honored my stops. I had a smaller account. You knew the commissions were 1% to 2%, depending on stocks or futures, which was very, very, Mark Minervini talks about it too. Like, we grew up in a different environment where the actual execution of the trade was very, very painful, but that was at least predictable. What would be worse is that if you had a small account and you didn't honor your protective stop. So now a small account is even worse underfunded, and now you're in a spot where you have to do very stupid things, right? And you're backed in a corner. The idea being is that when you have a small account, you really have to bet the ranch almost on one or two names at that point, because there's just not enough money to go around. My cure was to think in terms of notional value of futures, because I could trade so much more. Prices were lower, volatilities were lower, margins were lower, therefore. So I could get much more bang for my buck starting out. The good news, too, is that, and this is good news, is that there weren't all these stock index futures, which if I were you, I'd give up on. There's just too much noise. Every day you have to try to decipher, like, is this noise or signal? And it's like, if somebody in Germany farts, the S&P is up 2 points. Like, it's too manic. I would suggest trying to find something slower and steadier that's going to win that race. Anyway, we're talking about protective stops, because if you lose your money, you also lose your nerve, you lose your confidence. And if you're concurrently watching your P&L, that could put you on tilt. And that's not what's the point of trading. Your goal is to grow your account, not to win on any one particular trade, right? That's the problem people have, is that they want constant wins. The problem is that it doesn't work that way, and in the short run, we're all lucky. Doesn't matter who you are, be Tony Saliba, Michael Martin, to the newest person starting. In the short run, so much of it is random, it's lucky. But you got to protect your capital. And so take this, the first takeaway is, even as a speculator, your number one job is to learn how to play superior defense. While I don't think winners take care of themselves, you have to manage those too. You absolutely have to play superior defense. Second one is, I had consistent position sizes. Why? Well, when we make and lose our money based on our position sizes. You don't need sniper light. Now, if you're a scalper, you can click off the video, because none of this is going to make sense for you. But for people who want to take risk home overnight, take risk home over the weekend, right, and grow their accounts in substantial ways, this is more for you. When you have consistent position sizing, right, which means you can have different numbers of shares and varying degrees of contracts, but as a percent of your overall account, when you multiply, right, the number of contracts by whatever the multiplier is, right, because in options it's 100, but with futures it's all over the place, right? You could have, 100 troy ounces of gold, 5,000 ounces or 1,000 ounces of silver, because there's two contracts. You could have 25,000 pounds of copper, and then 5,000 bushels of the grains, which is, mind you, is volume, not weight. So you have to figure out what the vol is, right? Measure the number of contracts by the multiplier, right, the standardized size, multiplied then by the difference between your entry and your exit. Now, so that comes out to be a percentage of your account balance. This way, it helps temper your sense of fear and greed. Why? Because your bias of fear and greed are going to show up in your position sizing, not so much in your entries, at least in my experience. So I temper my hubris of like, I'm going gung ho for one commodity or another. At the beginning anyway, your initial entries, think about everything in terms of your risk unit, your R, and have that be one standardized size as a percentage of your overall capital. What is it that you're willing to risk of your account to lose, right, in order to be in the trade in the first place? This way, when you think you're onto something, which you may be, but without any data, it's guesswork. You don't go berserk over, say, crypto or shit coins or whatever it is you might be trading, and you keep yourself grounded. Two, when you go back to study your data, it's a lot easier if you can see that everything that you did had a consistent position size. Then that allows you to see, okay, for all the different styles of trades, I might scalp on this one, I might day trade this one, I might swing trade this one. I say try it all to see where can you find your edge. But I also say give yourself a finite amount of time. If you're trying to scalp and it's taken you 6 months, it's time to move on, right? You're younger, you might have money, you might not be in a relationship, right? Single guys are the greatest group or percentage of traders that are out there. So you don't have any responsibilities and you don't value your time enough. When we do in the coaching and mentoring, the first thing that we spend time on, literally before we even talk about a trade, is goal setting. And it's not like I want to become a profitable trader. That's a flaccid goal. It has to be much more specific than that. So as long as you know what your why is and what and why and how you want your trading to serve you in your life, then I'd say that you're probably better off, you're off to a better start than most. But the consistent position sizing is going to help your metrics, because then you're going to be able to isolate over a longer period of time where you do have skill and where you were lucky. We'll take luck. All of us will, myself included. But you want to be able to know, like, was it skill versus luck, right? And you don't want to, like, find yourself in a spot where you could do something very stupid with your money, make a lot of money, feel good about it. Whereas, when I was younger, I was like, man, I got away with murder on that one. Like, man, oh man, I have so much to learn. Because your blind spots in many ways can define where you are. And sure, if you make a mistake, but then you make money, good for you. God's got your back on that one. But at the end of the day, it's hard to build a career based on luck. You eventually have to exhibit some type of skill. The next thing, and I talked about it before, is because I was unsure of my footing and I didn't know where my skill was, I used consistent position sizing. I honored my protective stops. But what I did do was I added to my winners. Because when I was studying moves of a certain degree that would go on for weeks and weeks, both in stocks and commodities, I realized like I couldn't afford in the bigger picture, because my goal was to grow my wealth in my account, not necessarily to say like I bought a call option at 2 and I sold it at 4, I doubled my money. But who cares if you make $200 on a $10,000 account? It doesn't move the needle. At least that's the way my mind worked. I needed to think in terms of $500 to $1,000 wins, because again of the expenses. I need to not just pay for my losers, but I needed to pay for the commissions for all my trades, which were substantial. So I needed to think like, okay, on any given trade, I really have to have a target of $1,000. You see what I'm saying? So that might be, what is that? 200 shares. That moves $5, $1,000 for context. So what I thought was, and this is why I marked everything to the market, and I did what a lot of traders had come to learn how to do in terms of progressive exposure, is where can I get into a move, have it go sideways, like create a base. If you know about stage analysis, I didn't really read any of that stuff until I had kind of intuited it and figured it out for myself. And then give everybody a chance who wanted to take short-term profits, the swingers and the short-term traders who might have had much more money. But also, when you have a lot of money in those days, you could negotiate commissions down to like a 16th. or a 30-second, right? So you weren't paying the same rate. They had like 75% discount. They were probably paying more dollars because they were trading bigger size, but it was very difficult in a retail environment. So I also figured, okay, so the market goes sideways and it gives everybody a chance for the weaker hands to flush out. And then what happens if the move, when would be a good spot to add to my winner? And then I experimented with that. I did consistent bet sizing, adding to winners, which is more my style. I know a lot of people think it's crazy, but what's my goal? My goal is to grow my account, not to feel safe and to, feel like I can't take risk because I can define the risks. Then there's pyramiding, which is a way of adding to winners but decreasing your size as it goes up. You have to see which one, because to me they both work. You have to just see which one feels better for you. Also, I might as well mention here that there's a way to do that 2-for-1 trade. There's a lot of folks who like to put on their optimal risk size all at once. When it moves one ATR or whatever their volatility measurement is, they sell half. They raise their stop to break even. The problem with that for me was that, it was expensive, right, in terms of making money because of the commissions. But then also if the move continued, now I was underfunded. I mean, the account was underfunded, but I had lower exposure. So I had to think like, okay, if I have a 0.5% risk unit and it goes up by the ATR that I'm using to measure, I've taken 0.25% off the table in terms of profits. I can't lose. But now I only have 0.25% risk unit to move forward, and I would need the thing to move 4 ATRs basically to make 1%. So that style of trading didn't work for me because I never had enough risk on. I didn't have enough on at the beginning, but I couldn't afford to do bigger risk because if it worked against me, I'd lose all my money. Plus the commissions were punitive. So again, we're growing up in a different environment. You might be trading in an app or on a platform that has virtually no commissions whatsoever, so it's not an issue for you. You could trade like a Banshee. But for me, I needed to add to the winners, so offsetting risk at that 2-for-1 trade never made sense to me. I was actually looking to say, okay, if I'm up 500 on the trade, I'm willing to risk the 500 because I know if it comes back, I'm just going to get stopped at break even. So maybe I'll put a number in there that'll help me offset so that at least I'll pay for the commissions. That I definitely did. But then I thought, like, if this is working, why don't I add to this one as opposed to going out and hunting for other names? Because if the trend takes off, which you don't know at the beginning, you just don't know how high it can go, right? Humans are not really great at prediction. And again, go back to the past episode where I talked about do the hard thing. It's harder to add to your winners and increase the risk, right? Doing the safe thing feels good. So I knew intuitively that I had to make the tougher call because I figured, look, worst case scenario, I lose all my money, but I'm still young. All of my income earning years are in front of me. So that's why I did the next thing, which was I limited my number of positions to, at the beginning, like 1 or 2. And whichever one was going to break is the one that I would go with. I wouldn't sit and have 10 names on my wish list. I had several, and then I put buy stops in above the market, and then I let the market elect which one I should be in, as opposed to saying I'm emotionally invested in Intel. Or in those days, they had warrants that were trading at about half the price. INTCW was the ticker. They don't exist anymore because they were attached to a bond offering way back in the day. I think so long ago, Andy Grove was running the company. But at any rate, limit your names and think. Like even Bill O'Neill in his book, what is it called? How to Make Money in Stocks? Hang on, that might be right here. Yeah. Whatever that one is. Someone gave it to me as a gift, which is kind of like a joke because I'm mostly commodities, but nonetheless, it's a great book. Bill O'Neill, of course, founder of IBD. I have the 4th edition, and in chapter 12, which is the chapter on money management, which is all I ever really care about, even in most of my discussions with people, at the bottom of the page, it says for traders who have, between 20K and 200K, you should really limit your positions to 4 or 5, right? So that means you're thinking like you have 100K, you're looking at $20,000 to $25,000 of capital allocation to have those positions. I agree with that. Now, you don't have to put that on all at once. You might say, okay, I'm going to put 20K of my 100K to work. Maybe I'll do that 4 times in lots of 5K. So that this way, if the first piece works against me, I could literally buy $5,000 worth of it, give the thing 20% downside. And if I'm wrong, I'm only losing $1,000 or 1% of my overall capital. Now, as that name starts to make you money, you could, again, buy something at 10, let it go to 15, buy another 1,000 shares or whatever it might be, another 5K worth, and now you have an average cost of $12.50. So don't get excited about taking smaller gains because you just don't know. Like if you go back in history and look at some of the names, especially the tech companies from the early to mid 90s, not the internet bubble stocks, I'm just talking straight up tech stocks. Some of those things moved 300-400%. Some of them went up 4,200% if you just learn to have them and sit on your hands. And, maybe you can't catch the entire move, but it seems ridiculous to sit there and say, like, I'm going to scalp and take 10 points out of the E-mini or the MNQ when there's other names that you can afford, that you can put a modest amount of money in and just sit on them and let them go. Right? I don't think you have to become, Jack Dreyfus or Warren Buffett, but there is a way to trade and have that risk. So limiting and having more concentrated positions, albeit adding to those winners a little at a time, then what happens is you invest your gains into your protective stop so that if it does come against you, you're not going to get top ticked, right? You're not going to make or sell at the top, but no one does, right? Those are, again, short-term emotional wins that are costing you big money financially. So anyway, honor your protective stops. Consider consistent position sizes on your initial entry. Add to your winners when you can, whether you're using ATRs or whether you're going to wait for a base to form inside of a stage 2 uptrend. You can always add at the next breakout, right? Now, if things go parabolic, that's a different set of sell rules. But then if you do that and follow rule number 4, limit your trading to four or so winners, 4 or 5 winners in your account. That's how you're going to really grow your account because those moves can go on. Yes, they might come back on you a little bit, but that's not a reason to fall to pieces. Not at all. You're going to accumulate more wealth. And to me, that was the fastest way to grow a small account, was to not be full of activity, like trade up and down, this and that. There is math involved that we go through in the coaching program that can show you, like, when you think about what's your goal in terms of rate of return or dollar value, and then what your expected value is, there's a way to connect all that and figure out for your skill set what's your optimal position size. And it's very, very revealing. Anyway, you can do a lot of this on your own. And think about this episode with respect to stop looking at your P&L when it trades on, focus on your process, put in your protective stop, walk away, and then do the hard thing. Don't get excited about taking small gains. Let them run. Because, it's better to buy something, say it goes up $5. It might come back $1, $1.50 on you, and settle in, at which point you can come in and add more and let the thing go up $10. Now you're risking the unrealized gains, really, aspect of it, as opposed to your own corpus. I mean, that's what, if you have anyone that you're looking up to, I'm pretty sure that's how they're doing it. That's how they're growing their capital. Because then, even when you get bigger, like there's mutual fund managers that might be running billions of dollars, and they too aren't trading more than 10 or 15 names. Like, they're keeping it concentrated. It's not like they're not managing the risk, but they are definitely having more concentrated positions. And then when those things run, think about it. If you have a 20% position and the thing goes up 50%, now your account's up 10%. That's kind of, to me, what you're doing it for. So I would let go a lot of these lessons are trying to encourage you, or to consider anyway, to let go of making the small wins, to see what they add up to, and acting more intentionally so that you can actually grow your account with a number in mind. Because neuroscience has proven that if you set your mind to something, again, this is a huge part of the coaching program, that you could exactly get what you want, even if you don't know how to do it, if you put yourself in the feelings of doing it. So all these conversations are trying to help you come to terms with better, biological experiences while you trade, while you think about risk and how you feel. You have to shed your skin and get rid of the old you and start to adopt new behaviors, because that's going to predict where you end up. Anyway, I hope you have a great week. Thanks for being here. Click like and subscribe, and also get your free copy of the audiobook version of The Inner Voice of Trading. Links in the description. See you next time.